All right. Again, I know we still have some people rolling in here, but I'm going to get things kicked off in the interest of time. We have a lot to cover today, and I want to leave some time at the end for Q&A. For those of you that are new to our webinars, my name is Ryan Staton. I'm a managing partner here at StatonWalsh. Every quarter, we do market updates, much like this one, where we'll review what happened over the last quarter, some things to look for through the end of this year, and some things that you can do specifically in your investment portfolio, or some considerations as you're looking to that through the end of this year, and as far as a long-term financial planning perspective. So a lot of things to unpack here today, but I'm going to go ahead and get things kicked off. Also, if you're new to our presentations, you know that I always like to kick things off on a light note, and this year has been a little bit of a roller coaster. This GIF, honestly, I thought it was hilarious, but this is one that is representative of the speculation that's occurred year to year. Everything that we think is going to happen. So in this GIF, there have been conversations about bear markets, market downturns all this year. There's also been these, we'll call it glimmers of hope, these turnarounds, one of which is happening right now. We're kind of in the midst of it. But every time we think we're going deeper and deeper into a bear market, things start to turn over and look up. So we're going to talk a little bit about the economic environment, the environment in the markets today, and to figure out, where are we on the side of this, bull or bear, or are we in the middle, just kind of waiting to see what happens? Market cycles can be a little bit tricky. There's a lot going on in the world today. So there are some things that we can unpack and really hopefully give you some information that'll be actionable in your own financial lives. So let's just unpack the last quarter. What happened in Q3 from a market perspective, high level? When we look at the U.S. markets, three major indices: NASDAQ Composite, S&P 500, and the Dow Jones Industrial Index. These numbers actually remained relatively consistent. Not necessarily a good thing, but from Q2 as far as negative numbers in terms of market downturns. So we saw something similar from the S&P 500 in Q2. The quarter did kick off with a slight uptick. You can see there on the chart. We had a little bit of a bounce back there from the lows in June and July. But overall, we did finish the quarter down for all major indices. The global markets definitely took a larger hit when we look at developed European markets as well as emerging markets, which were the hardest hit during last quarter. We saw more significant downturns around the world. And we feel that as some of the economic data starts to come out, and as some of the factors that we're going to talk about later in the presentation start to come to fruition, that global markets are certainly going to have a tougher time in a potential recessionary environment. And so we'll talk about how you can view that, how you can look at that in your investment portfolio. Breaking down individual asset classes, this is the year to date, and then you can see the incremental returns. By and large, the winner this year has been commodities. A large portion of that has been increase in energy prices. This is something that commodities as a whole, if you look at 10-year returns, so if we fast forward all the way to the last column and we look at the bottom, has been the worst performing asset over the last 10 years. But this year, it's been really good. I think one of the things and one of the reasons why we look at this chart periodically is that if we stretch this out and we look at the market over a long period of time, there's really no clear winner year to year. There's no consistent winner that's at the top of the list. It is cyclical in nature. It does rotate quite a bit. But this can give you an idea of areas of the market this year that have done better than others. What you'll see below commodities is that pretty much everything else is in negative territory, not super positive on that front. One of the big I shouldn't say surprises, but one of the big factors that are affecting portfolio returns during the course of this year has been bond prices and specifically bond performance. What you can see there is that bonds are negative for the year, which is typically opposite of what we see in an environment where if the stock or equity markets decline, usually bonds are that diversifier or that buffer. This year, that hasn't been the case. So that's something that we need to look into a little bit closer throughout the course of the presentation. Figure out, how do we as investors react to that? Where can we go in the event that we have so many of these asset classes down? Because there really hasn't been much of a safe haven this year. The alternative, obviously, is cash. Up until recently, cash was earning nothing, and with a pretty high inflation rate, makes it a little bit challenging for you to keep up with the pace of inflation. So a lot of moving parts in this year's market. A lot of different asset classes have been all over the place, and so ultimately, what we'll talk about later in the presentation is how do we take all of that data and information and put it into action in moving forward in our portfolios. So looking at it through another lens, the performance of a diversified portfolio. Diversification is an important piece of any investment plan and specifically any financial plan. What we've seen this year, because of the performance of fixed income or bonds specifically, is that we're seeing that even more conservative portfolios are performing and experiencing rate of returns that are similar in nature to things like an all S&P 500 return portfolio. So as you can see here, the best performing portfolio so far year over year has been a 20-80. So 20% equity exposure and an 80% fixed income exposure. Much more conservative than the S&P 500. However, what you'll see is the S&P 500 total return over that same time period is only down 15%. So there's not a wide gap between the two. And that's presented a problem for a lot of investors, because regardless of your risk tolerance or the types of investments that you own in your portfolio, a lot have been experiencing similar downturns in their portfolio, which for many could be a call to action, can be a trigger to say, I need to do something different. And so we'll talk about other forms of diversification a little later, but I think this paints a very clear picture that it's been a tough market for most people. It's been a pretty tough environment. And so there are going to be some things that we're going to need to look more closely at, especially when talking about your own individual goals and planning and how your investment portfolios fit into that. A big topic of conversation, because of the action of the Federal Reserve and many central banks around the world, has been the interest rate. In our world, in the investment world, the conversation of yield curves happen quite a bit. What you'll see on the chart to the right is a representation of the yield curve from 1 year ago. And this is conventional in most cases and in most periods of time, which is the shorter the duration or the shorter time to years, the shorter years to maturity, I should say, the lower the interest rate will be. So what you could see there is 5-year maturity, 1%. And as you go out on that yield curve, the longer you're loaning your money out to someone else, the more interest that you're incurring for that loan or that debt. What we're seeing now is that yield curves have actually become inverted, which means that shorter or midterm durations are actually paying better than long-term. And that's a byproduct of rapidly rising interest rates. There is a reason that the Federal Reserve has stated that they're doing that. But ultimately, what this boils down to is we're seeing better rates in shorter term instruments than we're seeing in 30-year. And so short duration bonds are definitely a big piece of the puzzle here, and something that we're seeing a lot of investor money gravitate towards as we figure out how we're going to weather this storm, over the next 12 to 18 months and beyond. It's anticipated that interest rates will continue to rise in some way, shape, or form. That will be announced shortly. But if that continues, it is a possibility that we'll see this yield curve invert even more so than it already is. So let's talk about the macroeconomic data. U.S. housing market data is something that we look pretty closely at. This chart is one that we've included in all of our presentations this year. And this is a measure of things like home price index, housing starts, building permits, and what they've looked like compared to their 1 month, 3 month, and 1 year mark. Earlier in the year, when we looked at this, a lot of green up arrows. What we're seeing now is that as of this data is as of September 30th in most cases. Some of it spans into middle of October. But what we're seeing is that, house prices are coming down. They're still up compared to 1 year ago today. And they're even still up compared to 3 months ago. But one of the things that we're seeing is a leveling out or even a decline in home prices in some parts of the country. And in large part, that's because of rising interest rates and rising mortgage rates, more importantly. So at the time that the data in this presentation was vetted, the 30-year interest rate on a 30-year fixed mortgage was 6.7%. That in some cases has gone up, and that will continue to fluctuate over time. Ultimately, Federal Reserve monetary policy will also dictate where interest rates are as a whole, and financial institutions will have to make decisions on how to price mortgages specifically, over the next 6 months or so. Ultimately, what that will lead to is and I think the hope in some cases is declining economic activity. It sounds counterintuitive, but that's the Federal Reserve's position, that the economy needs to cool off in order for inflation to work itself out. One of the challenges that we're going to see, and one of the things that is still the big topic of conversation, is inflation. That's a trailing number that we use, and that's the number that they're using to make their decisions. Right, wrong, or indifferent, that ultimately trickles down to other areas of the market, which includes housing. So we've seen housing data change pretty significantly over the last 10 to 11 months. And we feel that it's probably going to continue to be that way. There are some things that have increased and that have increased pretty significantly. But we are living in a cyclical market when it comes to housing, and a lot of that will be directly tied to what policy is moving forward. Another big topic of conversation in financial news is the strength of the U.S. dollar. And some people might look at this and say, great, the U.S. dollar is strong. If you travel, if you want to go somewhere in the world right now, probably a good time to do it. There's some parity between the U.S. dollar and some other currencies around the world. What's the negative of that? Ultimately, it comes down to purchasing power of dollars from other countries around the world. So how that could affect the U.S., larger multinational corporations that are based here in the U.S. could affect sales abroad. If the buying power of a dollar of other currencies is less than the exchange rate with the U.S. dollar, that could create some problems for larger corporations. It could also create some trade imbalances. Just getting into the economics of it. That is in some cases can be positive, but a dollar that is too strong does have some negative implications to it. And so we've seen periods of history where this has happened, and the U.S. government has made deals with other countries to either weaken the dollar or to find some kind of parity in trade imbalances, and also just preserving the purchasing power for other countries around the world to maintain a global economy. What will happen in the future remains to be seen. We've seen the dollar spike pretty significantly in the short term. It's believed that it's going to continue to get stronger. This is something that economists will be keeping a close eye on to determine how strong the dollar will be and how it will affect the global economy. In reality, a strong U.S. dollar and a strong U.S. economy as a whole is great for us from an economic perspective in a period of recession. Where that hurts is the rest of the world. And so that will also affect decision-making in investment portfolios. If we feel that the rest of the world is going into a deeper recession or going to have a harder time weathering that storm, that may change investment philosophy slightly. So Something to keep an eye on, important economic data point that we look at when evaluating not just economic data, but investment data. So this is a slide that actually came from our last presentation. I left it in here because I thought that this was a really good look into the past. I also really love this quote from Sam Ewing. Inflation is when you pay $15 for a $10 haircut you used to get for $5 when you used to have hair. A great representation of kind of what's going on right now. And one of the questions we asked in our earlier presentation was, will inflation prove to be transitory or structural? So I think for the most part, we have our answer to that question. We're still in the thick of a stagnant or rising inflation number month to month. When we look back 12 months, we're still seeing some areas of the market or some areas of the economy where inflation is sustained and deemed to be permanent, and some where it may be relatively. We try to stay away from the word transitory. I don't think the Fed Chair Jerome Powell will ever probably live down introducing that term into his vocabulary. But at its core, transitory is meant to be temporary, and I think there are some things that will live up to that definition, but there are some that have become structural and are here to stay. And so when we look at U.S. core inflation, again, as this is a 9/30/2012 up until September 30th of this year, this gives you an idea of where inflation has been historically, at least in recent history, when we look at U.S. inflation rate and core inflation rate. So the long-term average and the long-term target for the Federal Reserve is actually around 2.5%. What we've seen is the published inflation rate that we all see is 8.2%. And that was as of September 30th. We should be hearing more data on October's numbers in the coming weeks. And so that will be an indication of what's our next move. And in the context of us being the Federal Reserve, do we continue to aggressively raise rates to tighten monetary policy, or do we give some relief and still hike rates, but maybe not at the same band as we've been doing at that 75 basis point hike? There are different views on whether that will be good or bad for markets, but ultimately sustained inflation over a long period of time is really not great for the economy as a whole. So you can see that spiked. You can see that does not represent a transitory trend as a whole, and that it has been relatively sustained at high levels throughout the course of 2022. So we'll be watching that closely. So why is inflation today's most popular water cooler conversation? This is a question, and I think this is the old adage that perception is reality. This is an important piece to many people. And the reason why inflation is such a controversial topic, when you say, I don't think inflation's that bad, or someone says inflation isn't 8%, it's 15 or 20%. Why do they have that perception? And the reality is that there is no real inflation rate for the masses. The inflation rate that's published to all of us is a calculation based on a lot of different data points, but ultimately we don't live our lives within that data set. And so what do I mean by that? We all spend our money differently. So inflation rates are different for every individual household. An example of that would be if I have a 100-mile round trip commute every day, my inflation rate is certainly higher than the person that's staying at home and working from a desk inside their home and has no commute. The reason? Price of energy, the price of gas. As those prices went up, I experienced a greater rate of inflation on travel because I have to drive to and from a location to work. The same can be true for groceries or other items. It's a very realistic possibility that there are some people in our society today where their inflation rate is next to nothing, because the way they spend their money and the way they live their life is different than the person that lives next to them and so on. So inflation has become a controversial topic because there's a published rate and then there's what we actually experience day to day, and which can be very different. It can be more or less. And so the perception is the reality. Ultimately, that trickles down to consumer sentiment. And that's what we're seeing in the market today. But I think it is an important thing to understand that understanding what your actual or your own inflation rate is an important piece of the puzzle, and not getting overly married or tied to whatever the published rate is. That could be good or bad for you. If it's greater, obviously that's a larger hill to climb. But in some cases, depending on lifestyle and what has changed or has not changed, there's a very real possibility that maybe your own inflation rate within the household is not what's published. So let's talk about inflation drivers. We talked about why everyone's inflation rate might be a little bit different. The chart on the left is a representation of why. So the drivers of inflation, or the CPI, Consumer Price Index, that they utilize for publishing inflation numbers. The colored bars represent different areas or different items that make up that inflation rate, ranging from energy, vehicles, food at home, restaurants and transportation, or what we call leisure, and then shelter. And so what we've seen steadily since last year is the cost of shelter has gone up pretty significantly. And we feel that that's a piece of inflation that's not transitory in nature, that has some staying power. And the same is likely true for areas like restaurants, hotels, and leisure. A lot of them making up for lost time through the pandemic. Like it or not, that's what's happening. We're seeing increased costs of operation, increased costs of some of those items, and we feel that a lot of that is probably here to stay. But what you'll see is that those bars may change in terms of their share over time. You see new and used vehicles a year ago made up a much larger share than they do today of that 8.3%. And so these numbers will fluctuate, they will change over time. And depending on where you are in your life and what financial decisions you have ahead of you will determine really what your inflation rate will be and what the drivers of your own personal inflation rate will be in your household. On the right-hand side, this is a conversation about expectations. I think expectations on inflation as a whole are relatively contained long-term, meaning that most people do not believe that an 8 or 5, 6, 7% inflation rate is sustained or sustainable, that will be the norm for the next 3 to 5 years. I think the belief is that in the short term, inflation will end up being higher, but over the long term, it will normalize and get back to an area where it's believed that long-term inflation expectations will be in that 2.5% range that the Federal Reserve has kind of targeted based on their policy. So even with everything going on, you could see professional forecasters and consumer expectations are relatively close. So everyone is of the mindset that inflation will come down at some point and will be relatively manageable long-term. So that's all the economic data. Now let's take a minute and talk about the investment outlook. So what do we see through the end of the year? And so because this presentation was generated using third quarter data, I wanted to go back and update it as of the start of this week. These are the numbers. If you get our weekly market insights, we publish these once a week, as well as some other items and other news around the markets. So this was as of 10/28. What you'll see is the Dow Jones Industrial Index for the year was down less than 10%. The NASDAQ down 29. MSCI EAFE is basically a worldwide index. So that's looking at the global market. And then the S&P 500, the largest 500 companies here in the US, down 18%. So you can see that there's a pretty wide range there. And, the Dow Jones and S&P 500, both representative of US companies, the NASDAQ as well, some in very different sectors, but you see that there's very different performance amongst the different indices. There has been a bit of a rally over the last month or so. So a lot of the data that we saw at the close of Q3 has changed. Quarter to date, or month to date, I should say, the S&P 500, for example, was up about 8%. So, we're seeing those big swings. And it's month to month, day to day. We're kind of going this peak to trough approach, and a lot of people are really trying to figure out, what do I do in my investment portfolio? How do I weather this storm? Because this has become the norm over the course of this year. Part of the reason that investment performance is being driven into negative territory, obviously, Federal Reserve and monetary policy were a big piece of that, but also falling consumer sentiment. It's believed, and the data shows us that most consumers believe that we're actually already in a recession. I know there was some arguments and some back and forth earlier this year on semantics of or economic definition of recession and what is a recession, what's happening, what's not happening. Ultimately, it doesn't really matter what any politician or any economist says. Most consumers think we're already there anyway. And so what that does is it drives market behavior to start to position yourself to weather a recessionary environment. That can cause, large sell-offs and other things that we've seen throughout the course of this year, not just from individual investors, but from institutions as well. You see in that red circle at the bottom there, that is pretty much the worst consumer sentiment numbers, annual year-over-year change in 40 years. So I think that, again, perception is reality for a lot of investors. And what we're seeing is a lot of people are worried about what's going to happen in their investment portfolios moving forward. So the natural question becomes, what should I do? Where am I in the market cycle? Are we at the peak? Are we at the bottom? Can we go down more? This data as of, again, September 30th, 2022, represents where the market was at that point. And one of the reasons I really like this chart, our partners over at JP Morgan Asset Management generate this as part of their quarterly guide to the markets. This shows intra-year declines over the course of a 42-year market cycle. And why is this important? The red dots on the bottom of the screen represent negative numbers during that course of the market year. So, for example, we'll just pick one. At one point in 2008, the market was actually down almost 50%. Now, the S&P 500 finished negative 38, still not great performance. But the point was that if you got to negative 49 and you decided to cash out at that point, by the end of the year, you missed an additional upside between negative 49 and negative 38. Again, it's a silver lining, but it's an important piece of this puzzle. It's also an important piece of the planning that you're doing around your investment portfolios. You really have to make sure that, one, you have a complete understanding of what can actually happen in your investment portfolio. So what downturns are possible? What is a loss that I could realistically see in my portfolio, so that you understand that, this negative 19% right here can happen, but the market could also still finish flat for that year. And so making rash decisions when your portfolio is down 9% could cost you the ability to recover all of that negative rate of return and potentially finish out where you started, or in many cases, what we see on this chart, ahead of the game. And so as of September 30th, we were in that place where we were actually at the bottom of the market for the year. We had hit that red dot. And so many investors look at that and say, is this truly the bottom? Can we come back from this? The answer in 32 of the last 42 years that we look at here is yes. Am I saying that the market is going to rally back down from 25% by December 31st and be in positive territory? No. I don't know that that is a realistic assumption. I don't have a crystal ball to be able to predict that. I also think that is that might be a little bit of a stretch. That's our opinion, and that is something, however, that history has showed us can happen. And so I think the more important thing is trying not to get spooked by the red numbers is the hardest part of investing. It's the hardest part of this process. If this was easy, everyone would make a ton of money. We'd all be rich, and we wouldn't be sitting on this call right now. But the reality is that this is hard. These are the periods of time that get very, very challenging. And so as far as what to do next, I think there are some reasons for optimism in your investment portfolio. One reason for optimism is a healthy job market. It may not feel like it right now, but there are a lot of job openings and a lot of available people to fill those jobs. Whether or not they fill them or not, another story. But from a job market perspective, when we look at opening rates and job openings per unemployed person, we see some parity there. And that's usually a good sign for the economy. You see 2020, the COVID pandemic, there was a sharp downturn. We've kind of started to recover from that and have gotten back on track to our pre-pandemic levels as far as job market is concerned. Now, if you talk to many employers, some are having better success than others in hiring. There's been a rapid increase in wage growth, which has created, an increased cost for many businesses, which has ultimately trickled down to consumers and will continue to trickle down to consumers. It's also why we feel like inflation will be permanent in some ways. However, as long as long-term inflation and wage growth have some form of parity, that's usually a good thing for consumers, and that's a good thing for the economy. So one reason for optimism, a healthy job market. Another reason for optimism is the U.S. consumer is actually still relatively financially healthy. So we look at a couple different metrics, some like debt to income ratios or debt to assets in households. The biggest, the most eye-popping statistic is that bank deposits are still $2.7 trillion above pre-pandemic levels. There's a lot of different reasons why. We saw a large infusion of cash into the economy with several pieces of legislation that occurred during COVID. But what happened is many people sat on that money. They still didn't spend it. And so there still is, hard to believe, but there still is some significant pent up consumer demand, and there's cash there to pay for those goods and services. And so a healthy U.S. consumer ultimately means healthy economic activity. We feel like people may be more selective with their dollars moving forward, but it is something that we look at pretty closely, and that investors should really pay close attention to when they're looking at the selection of investments in their portfolio. I don't think that moving away from stocks or equities or getting into investing in certain companies is something that we should consider, and ultimately pulling back and going to our safe haven of cash. But this is an indication that consumers still have cash on the sidelines that they're not deploying, and that can be deployed in several different ways. It can be invested, or it can be used to purchase goods and services. And so I think both are good for investors and for the economy, and it's something that tracking what that looks like over the next 6 to 12 months, even at a potentially higher inflation rate, seeing how those deposits pan out and if they still maintain a large surplus in comparison to what we've seen in years past. So how does this translate to investing? Well, I think the most important thing, and ultimately, and sound like a broken record if you've listened to a bunch of these, but there is a behavior gap between the average investor and what the market that we see day to day does. And this representation, I just decided for this one, I was going to draw it out for you guys and actually write it out, because I think that it's a big number. And if you look at it over a 20-year period of time, a compounded 5.9% is huge and it has a huge effect on the performance of a portfolio. And so what this chart represents is the performance of asset classes over the last 20 years annualized. And what you'll see is that, every asset class has been a little bit different. There's a couple highlighted bars there, the S&P 500, a 60-40 portfolio, a 40-60, what inflation has been, commodities, cash, etc. And what you see is that if you were just a plain index investor and you bought the S&P 500 on January 1st of 2022, and you held it until December 31st, 2021, you would have averaged an annualized rate of return of 9.5%. Now, the tricky part is you would have had to weather the economic crisis in 08 and 09 and live fearlessly through a downturn of over 50% in that time frame. And then also live through a downturn of almost 30% during the beginning of COVID. So this is the challenge in investing, is that right now it feels like we have an existential crisis. And in any other phase of our lives, when there's an existential crisis, we have to take action. Simple example, if your house is on fire, you need to call the fire department. You don't just do nothing. But investing is counterintuitive in the way that in investing, sometimes when you're going through an existential crisis, volatile markets, the best thing to do is nothing. Now, the important piece is that you have an investment allocation that fits your risk profile, that fits what you're willing to accept. Going back to that chart with the red dots on it, you have to understand that you have to have a good understanding of what is possible on the downside before you can realize your upside here. And what we've seen is the average equity investor has not done that. And the proof is in the data here. This isn't, this isn't something that that we've created. A company called Dowbar that does tons of consumer studies did this, and the numbers change every year. This has actually gone up by and large, most likely because now with going from 2002, we're removing the early 2000s and post tech bubble, what happened in the market there. The other piece is that we're including a big year in 2020 and 2021. And so for most investors, they had positive investing experiences. I say most, not all, but what we've seen is that average has increased, but so has the performance of some of these other asset classes. So what does this really mean? Discipline is key. I think you could pick a lot of those other asset classes individually, or you could go with a more diversified approach, which would be recommended. But if you were to do that and hold it, you would outperform the average investor that you're sitting next to every single day. And that's a staggering statistic, and that's a big number. I mean, I just used the S&P 500 in this example, but we could do this a number of different ways. We could go down to a 60-40 portfolio. The reality is that every 1% of missed compounded return over time adds up. It's a big difference. And to use a drastic example, that would be the difference between a Warren Buffett being worth $100 billion and being worth $10 billion. So big difference. And it gets into big numbers, but we talk a lot about this behavior gap because times like right now ultimately drive behavior. Unfortunately, what the statistics show us is poor investor behavior. So the best that we can do is educate ourselves and make sure that we understand what's possible, but what's also what we need to do for our own individual situations and maintain that discipline and focus on our long-term financial plans. So what things can we watch through the end of the year? What's going to determine what happens with the market? Inflation report is a big one. When that comes out, Federal Reserve may or may not make changes to their policy on interest rates. That may change the long-term outlook on where we think inflation is going to be or what the interest rate environment is going to be. I think for the most part, as I mentioned before, long-term expectations on inflation are still relatively contained. Nobody is forecasting that we're going to have sustained inflation of 5, 6, 7, or even 8% for an extended period of time, which I think is positive for the markets. There are some indications that inflation is peaking. We'll see when the data comes out, but some of the economic data that we've seen shows that supply chain pressure seems to be easing a little bit, and that also the commodity prices are falling. Still relatively expensive compared to their, let's call it pre-pandemic levels, but those are things that are big drivers of the inflationary environment we're in right now. And if we see easing in those two areas, as well as some slowing in some other parts of the economy, there's a pretty good chance that inflation will come down. And more importantly, that the Federal Reserve could be deemed to be less what they refer to as hawkish or aggressive on their interest rate path here moving forward, which could be positive for the markets. I think the other thing to look at is corporate earnings. We just kind of cycled through an earnings season, and what we've seen is that even though inflation is up and all these other negative things that are happening in the world, we're seeing that corporate earnings have been relatively resilient this year. There have been some companies that have fared worse than others on an individual company basis. They're not all great. But I think as a whole, we've seen corporate earnings be very, very resilient in an environment where most thought markets going down were directly related to consumer spending, corporate earnings, things that were happening. And that just hasn't been the case. We've seen stock prices dip for some of these companies, but their corporate earnings do not reflect, I think, a fair value or a fair trade of that. Ultimately, what we're seeing happen is valuations and pricing on some of those equity securities are probably a little overinflated. And so there's something in our world that we call mean reversion, which means that there are several data points within the pricing of a company or valuation of a company and a pricing of a stock that get a little overheated from time to time, but we always seem to revert back to our mean. And so, and our mean or our average. And so that's something that certainly has happened this year. It's not because companies aren't doing well. It has more to do with, they're probably trading a little bit above maybe what they're worth. So what do you do as an investor? Wrapping all of this up, what's the path forward? At a high level, remain disciplined and focused on your long-term financial plan. Your planning, just like that inflation rate that I talked about, it is different for every single household. Your plan and your investment strategy should be the same. It should be the same in that way, and that it is different from every other person that you're talking to. Talking about investment portfolios and what friends and family and others are doing, it can be helpful, but sometimes it can do more harm than good. And the reason is that the way you spend your money, the way you think about money, the way you think about investing, and ultimately what your financial plan is likely going to differ from friends, family, acquaintances, colleagues, and the like. The other important thing to remember in a downturn like this is that many of the strongest market gains have followed periods of pain for investors. So that's really where we get into the understanding of, I know what can happen. I know these things happen. One, am I positioned in a portfolio that I'm comfortable with? And if that's not the case, that's the first step, is getting to a greater level of comfort. But two, having that understanding and being able to weather this storm will ultimately reward you long-term if you can maintain consistency and discipline. The biggest thing to focus on is resilience in your portfolio. So how can we have a resilient portfolio? You can diversify. Diversified portfolios, as we saw in one of the earlier slides, have not been immune to market downturns this year. However, there are other ways to diversify portfolios. You saw that, for example, alternative investments or commodities falling into that category have outperformed everything this year by a mile. And I think a lot of investors get away from certain asset classes when they feel like they're not performing up to the rest of the market. And so we have this philosophy when we get started that we don't want all our eggs in one basket. We want to properly diversify, and we do that. But then one part of the portfolio doesn't do well, and then we get the itch to, this isn't what I want. I don't think this is doing well. I'm going to switch it over to all this stuff that is doing really well. And what happens is, in a cyclical environment, and the economy is cyclical and so are the markets, we rotate out of these positions, and what happens is they start to perform. And then we want to put money back into them now when their price is increased. Stocks, interestingly enough, are one of the few things in the world that investors do not, or consumers do not like to buy on sale. Anything else in your life that you saw a sale and that you wanted and that you felt would increase in value, you would 100% buy that if it was on sale. Stocks seem to be the exception to that rule. And look, not all asset classes are going to be on sale. There are going to be some that are going to be more overvalued. And yes, there is an idea that you don't want to have all your eggs in one basket. And you also don't want to chase returns. And so ultimately, diversifying your portfolio and considering other asset classes, maybe that you have never considered, or that you've had before and you've rotated out because you felt like the performance just wasn't up to par of what you needed it to be. I think getting back to a more fundamental approach and really sticking to a long-term plan and investing is going to be helpful for many investors out there. And alternatives can mean a lot of different things for different people, depending on what industry you're in, or if you have outside investments, your business, real estate, other types of investments would also fall into that category. Focusing on quality. Companies with strong balance sheets. So here's what we mean by quality: a strong balance sheet, consistent earnings, and companies that pay and grow their dividends over time. I think we got caught in a little bit of a vacuum in 2020 where, quite frankly, it's a blunt statement, but it's true that we thought we could throw a dart at the wall, pick a company, and it would go up by 20%. And that may have been true in many cases. What we're seeing now in this reversion back to fundamental investing is that companies actually have to make money to have a high stock price. It's not true for all. Again, there are exceptions to that rule, but for the most part, companies have to have cash flow, have to give you something in return for what you're paying for. And so the focus on quality has become a point of emphasis for us. And we're seeing it now with many investors. One thing that we look at is fund flows and where people are taking their money from and where they're putting their money. And interestingly enough, a lot of those growth-centric funds and stocks that people had been dumping a bunch of money into over the past couple of years are now seeing the largest outflows. And we're seeing people move money into quality, blended funds, companies that pay dividends. And I think there's certainly a method to that, but you want to have those companies in your portfolio on a regular basis, on a pretty consistent basis. I don't think it's advised to go back and forth between one asset class and the other. It is really important, going back to the original point, diversifying, but also including high quality companies, especially if you're in a portfolio where you're investing in individual stocks. The last piece is considering risk mitigation strategies. There are a lot of different things that you can do within an investment portfolio to mitigate risk. I think ultimately this becomes behavioral. We want to create, and you, I think ultimately will want to create the smoothest ride possible for you in your investment journey. And so if your plan dictates that you need additional protection against market downturns, there are several types of risk mitigation strategies that exist out there. Some are more tactical in nature, meaning a relative timing based on specific triggers of different trades or money movements that occur. Others may be long-term or more passive in nature, but have an inherent risk mitigation built into them. And we can certainly have conversations and unpack those individual strategies with all of you. I think those are one-on-one or individual considerations, but there are many different risk mitigation strategies out there. And if you have a feeling that volatile markets are here to stay, and that is something that might be bothersome or something that might keep you up at night, let's just be honest, then there are things that you can do to still weather the storm, still participate in the growth and upside of the market, but potentially reduce your risk of loss at the same time. So a lot there. I'm going to open it up for questions just in the interest of time. And so feel free to use the chat box. There's a Q&A feature as well. If anyone, it looks like someone has their hand up here. Happy to unmute if somebody wants to actually talk to ask their question, or feel free to type it in here. So. All right. So one of our questions, geopolitical question, what about a black swan, Putin, and the impact on the market? Geopolitical issues have been a big a big consideration this year. I think we've seen several market fluctuations due to the geopolitical environment. There's always a risk. I think that by and large, the biggest drivers of the market today are certainly economic in nature. That doesn't mean that geopolitical issues can't have an effect on the market in the short term. Unfortunately, in some cases, when you talk about, and mentioning specific leaders around the world, you can't really control volatility and what's going on in someone's mind. And so if one country decides to take action against another, more severe in nature, or a nuclear attack or some other things that have been tossed around. And so in that case, we really can't predict what the effect of that will be. Ultimately, the market is an indicator of what we believe is going to happen in the future. It seems counterintuitive based on today or this year's experience, because we all feel like we're looking at what numbers happened in the past, and then the market seems to react to that. But really what the market is doing and what the market is designed to do is try to predict what the future will look like based on that data. And so, unfortunately, a geopolitical event is a reactionary thing. It's not something that there's no prediction of what will actually happen. And at this point, it's a coin flip. I think you could try to hedge your bets against that, but if it doesn't end up happening and everything economically that every positive factor that we talked about today comes to fruition, then you're missing the mark. We're trying to time the market. And so I think comfort level and diversification are probably the biggest keys to investment philosophy, even in a volatile geopolitical environment. But it's not something we haven't seen this year. It's been relatively temporary. I don't think anything that's going on in the market is necessarily, I would say, primarily driven by geopolitical events. I think there's a lot of other things at play here. It's a good question. I think coming up with an answer to how to hedge that is something that it's impossible to predict. I just leave it at that. But it's a good question. I think it's a question on a lot of investors' minds. So we'll open it up here and see if we have any other questions. Follow up to that question: best parking places for cash now: savings accounts, CDs, bonds, treasuries. I think from an interest rate perspective and liquidity perspective, all of those are viable options. And I think it comes down to what you're feeling on the market moving forward. More importantly, what's your general feeling on interest rates? I mean, they're going to fluctuate. All of those instruments mentioned, bank instruments, savings accounts, some are going to be better than others. I think from a cash perspective, they all serve their purpose as long as you're using the appropriate duration. And so I think that long-term, cash is probably not a good place to be. It's a safe place to be if let's just say you're in an insured account or you're using government securities that are backed by the full faith and credit of the government. But long-term, from an investment perspective, you're not going to outpace inflation. And so I think it's a short temporary hedge. Timing getting back into the market from a cash position is a tough one. One that I don't think very many or anyone has really ever been able to figure out. Precious metals are not behaving as an inflation hedge. This is a good question. So it's a question we get quite a bit. When inflation is up, where are places we can go? Gold, silver, other types of precious metals. And so the price of precious metals usually kind of keeps pace with inflation when we look at macro data and as a macro hedge. It really hasn't been the case this year. And so there have been cases where gold, I'll use gold as an example, has not outpaced inflation. And then there's other periods of time where it has actually greatly exceeded inflation. It tends to be, it usually is a relationship that has parity. Why that hasn't happened this year, it's an interesting thought. And I honestly, I don't know that I can answer specifically why that's been the case. But the second part of the question is, has there been other times in history where this has happened? And there have, in small increments, but not by and large. And so the data on that is interesting. There have been I think it's important to note that there have been a lot of things that happen this year that don't traditionally happen. It has been a very strange year in that way, not just precious metals and the correlation to inflation, but also fixed income and some other areas of the market that have just not reacted in a way. There's a lot of speculation or a lot of different opinions on why that is. I'll save my speculation for another day, but I think from a data perspective, these are rare events that don't happen often. And so I think that's something that we should definitely take into consideration when we're looking at investment philosophy moving forward, and especially over the long term. Things that are not ordinary tend to be temporary, and following those periods of time, what we've seen historically in the market is that there are pretty significant gains and rebounds after following events like this one. And so having diversification, in different areas of the market is going to be the key ultimately. And I think diversification, not just of asset classes and of risk, but also tax diversification. One thing that we didn't talk about much is legislation. This time of year is very popular for legislative changes, especially with tax law. So that's another thing that'll be coming down the pipe that we'll be paying close attention to, because that certainly will affect the way that investors position money, not necessarily in the market, but the types of accounts that they're utilizing for that. Okay, well, we have another minute left. If there aren't any other questions, I welcome everyone to go about their day. I really appreciate you spending the time with us today. I know that many of us have busy schedules, and so we really, again, we appreciate your time. We appreciate your participation. If there's anything else, the last question: if Philly wins the World Series, will the market correct? The data says yes. Unfortunately, I think I don't want to offend anyone that's a Philadelphia Phillies fan on with us today, but the Phillies must be stopped based on history. There have been several occasions where they've won the World Series where we've had large market downturns in a global financial crisis. So one of two things is going to happen. They're going to lose and all will be right in the world, or they're going to win and hopefully we'll beat that trend. I don't know the answer to that, but I imagine there will be people somewhere, because this is just how we behave as humans, that will position portfolios differently if that is the outcome. I hate to say it, but I think it's reality. Being a baseball fan, I think that I don't know that the two are. I think it's certainly a strange coincidence. Let's just say that. I don't want to speculate any further what might happen based on the outcome of the World Series, but it is an interesting thought and an interesting stat that I saw that I wasn't super comfortable with when I found out. So with that, we'll wrap things up here. Again, thank you everyone for your time today. I really appreciate it. Thanks for being on. I know we unpacked a lot. If there's any other questions, please feel free to reach out to us. We're happy to answer any questions post presentation. And then, if there's anything more specific that you'd like to discuss, please feel free to contact us. Again, this is being recorded, so there will be a recording. If you want to review any of the slides, we'll also have the slide deck, PDF of that sent out as well. So appreciate your time, appreciate your participation, and we'll look forward to seeing everyone at the end of the year, and hopefully with much more positive news talking about the market. So thanks again, everyone, and we'll see you next time.